Morning, good evening, good afternoon, wherever the heck in the world you are. It's the one and only V, the Gorilla, coming to you live. Actually, this is a pre-recorded show. We're doing another edition of Rogue Money Interviews, and we have none other here than a very, very important person, Danielle DiMartino Booth, Danielle DiMartino Booth, who has written the book Fed Up, a great insider book that speaks about exactly why it's important for us to understand what this monolith that is called the Federal Reserve. What is it and how it impacts our day-to-day lives? Most people still don't have a clue on what the Fed is. And Danielle is going to go into a deep dive and detail for us what her book's about, her experience working at the Fed, and her background real quick, guys. You know, she's come from Wall Street to a respected columnist to a Fed advisor, okay? Danielle spent 9 years as senior financial analyst with the Federal Reserve of Dallas and served as an advisor on monetary policy to the Dallas Federal Reserve President Richard W. Fisher until his retirement. Fisher called on Danielle to serve as the Fed at the Fed after becoming a loyal reader of her financial column in the Dallas Morning News. She began her career in New York at Credit Suisse and Donaldson, Lufkin, and Jarrett, where she worked in fixed income, public equity, and private equity markets. Danielle earned her BA as a College of Business scholar at the University of Texas, Hook'em Horns at San Antonio. She holds an MBA in Finance and International Business from the University of Texas at Austin and a MS in Journalism from Columbia University. With that being said, Danielle, thank you for doing this interview with us. A lot of ground to cover, a lot of great information. So welcome aboard, Danielle.
Thank you so much. I'm excited to be here.
Absolutely. So where do you want to begin? I mean, let's talk a little bit about you, and then we can deep dive into your book and what this whole thing is about, Danielle.
Well, you know, I think, excuse me, I think what life is funny sometimes, and it's circuitous because you're like, why did she end up being a columnist after, why leave Wall Street? Those two buildings falling down changed all of our lives in many different ways. And I had been going to Columbia at night. When I lived in New York, the market would close. I would run across town, jump uptown, and go to night school. And after those buildings came down and I started long-distance dating the man who would become my husband, when push came to shove, Michael Lewis's book, which had such a profound impact on me, Liar's Poker, and my husband-to-be said, just transfer to Dallas. And I said, equities in Dallas. So that's the running joke in my life, is that because of one little line in Michael Lewis's book, I ended up signing a non-compete and agreeing to leave the industry for a while. And that's what put me on Richard Fisher's radar screen, and then ended up being the most important chapter of my life. Was going to serve the country and work at the Federal Reserve, obviously at a very tumultuous time as the financial crisis was descending. And that is what took me to the point where I was several years later really fed up.
Very well said. I mean, talk about divine appointment. It's like fate had you, set yourself up where you literally were positioned to see the belly of the beast firsthand.
It's interesting because Credit Suisse bought out DLJ, and DLJ was a great, wonderful, entrepreneurial, old-style investment bank where you eat what you kill and you are what you produce, and the numbers reset, at the beginning of every month. And but it was also at Credit Suisse after the buyout that I was first introduced to the whole concept of a collateralized debt, you name it, anything, and thought to myself, who, and this is actually the title of a chapter. I'm like, who would buy that crap? And it was kind of that attitude that I carried with me when I left Wall Street and ignited my interest in beginning to follow the housing market as closely as I did. And because I understood the structure of these collateralized debt instruments, I was able to understand the implications because I knew the traders on the desks were selling them off here, there, and everywhere. We come to find out, it's some obscure German Landesbank that blows up first. And it gave us an idea of something that became critical as the crisis unfolded, and that's the concept of systemic risk, contagion.
Absolutely. Could you describe for the audience what contagion, what is that systemic risk, and how that's so prevalent today in pretty much the entire equities market in the United States?
Well, I think systemic risk is a little more difficult today to define. Back in '05 and '06, we pretty much knew that systemic risk could emanate from these haphazardly, riskily underwritten instruments that were kind of convoluted. But there was really one singular focus, if you will, and that was the subprime mortgage market. Today we have record low bond prices. Record high bond prices. We've seen some of the lowest bond yields in the history of mankind, and how that's playing out and where that's showing up today is really everywhere. I'm not trying to be hyperbolic here at all, but we know that low prices for debt have fueled share buybacks, which has fueled this magnificent rally that we've seen in the stock market. We know that ultra-low yields have put commercial real estate prices higher than they've ever been, even in '07 and '08. We're starting to see some of the aftermath in stresses emanating from the household sector. We just got a fresh report out on GDP. We just got fresh numbers out on inventories. Motor vehicles and parts inventories are up nearly 10% year over year. And so you start to get a sense of what happens when credit bleeds into an area of the market and hits its capacity level. And in this case, it's subprime autos or credit cards or student loans or FHA mortgages, again, where cheap credit has bled, but to too great of an extent, and now households are beginning to default. And these are, again, the ramifications of the Fed thinking, wishing, willing, it's too low for too long serial policy into the credit markets, rather than try and step back and say, you know what, that really didn't work in the years that led up to the dot-com implosion, 2000. It didn't work again in the years that led up to the housing bubble and its subsequent explosion and the financial crisis that followed. And yet, here we are again, seemingly Bill Murray cast in Groundhog Day, because that's kind of what it feels like to watch this.
Yeah, very well said. Very well said. I mean, it literally is like this day in and day out over at the Fed, without a doubt. Great analogy. What's your take on the Fed? Why do you think they are, doing the same, basically the definition of insanity, doing the same thing over and over and over again, expecting a different result, and always seeing with all the stimulus, with all the cheap credit flooding the market, all we're seeing is capital malformation. We're seeing capital destruction. We're seeing the valuations of assets going out the window. I mean, what is going on? Why is it that they don't seem to get it? Or are they doing this on purpose? Who knows?
I think that what the Fed is communicating is a simple desperation. If there's an acknowledgement that this Keynesian school of thought is broken or has been pushed too far, I think Keynes's name has almost been damaged and besmirched by central bank policies. I like to think of him as spinning in his grave, because the extent to which quantitative easing has been deployed would make even him blush. But the problem, I think, to answer your question, is I don't know that central bankers worldwide have a different solution that they can offer. So other than a blanket refutation of their way of thinking, which means, the first part of the first step on the road to redemption, if you will, for the Fed would be recognition that they're wrong, and that's really, really difficult to do if and when you've been infected by a God complex.
Describe for us what this God complex is that we see with these central bankers.
Well, they think that because, and this is how backwards their thinking is. So the politicians won't do their job. So we as central bankers had better step in and be noble in our deeds. and do what the politicians won't do. They kind of pat themselves on the back. What they don't understand is that if Uncle Sam's borrowing costs are 1.8%, the politicians are going to, of course, they're going to sit on their hands. Of course, they're not going to lift a finger, because it's really easy to finance the stealthiest, I call it, expansion of the social safety net since FDR was alive and in office, when you've got borrowing costs that are that low. So why, as politicians, do you take on the difficult decisions? You leave inappropriately and incorrectly, you leave that labor mandate in the Fed's hands, even though we should start to recognize that, hey, maybe we made a mistake in 1977 by expanding the Fed's mandate to include maximizing employment, because clearly interest rates are not the right tool to fix the problem, and maybe that should be the job of the private sector, and in cases of emergency and financial distress and recession, the job of the Congress.
Yeah, absolutely. What do you think is the what are some of the other things that you ran into? You went into the Dallas Fed, you started getting into the apparatus of this machine. What are the things that really opened your eyes to wow, these people seem to be just absolutely married to a dogma, it seems like? Well,
it was, you're going to laugh at me. I'm not sure if you have any background at all on Wall Street, but it was the smell.
The smell.
I think I'm nuts. I would walk onto the trading floor. Now, bear in mind, DLJ was on Lexington between 47th and 48th, so Smith & Wollensky's, a famous steakhouse, was within delivery distance. So you would walk onto the trading floor in the middle of the day, and it would literally smell like red meat. And you would sense the energy, and the productivity was in your face, as opposed to inside the Federal Reserve, where productivity was something on a spreadsheet that went back for a century of data and was seasonally adjusted to kingdom come and irrelevance. And when I first entered the Fed, my nostrils were simply not violated by anything. It was the library meets the hospital. It was such a sterile environment. And bear in mind, I'm coming in 2006. The housing market is not, it's not threatening to roll over anymore. It is rolling over and peaking. The foreclosures are going through the roof. The East Coast and the West Coast, Miami had a mushroom cloud over it. The Inland Empire, you name it, the Sand States. All of these things were happening in very real time. And you enter the Fed, and it's just as quiet as can be. It's like nothing's happening here. Nothing to see, folks. Move on.
Yeah. Wow.
And it was just astonishing to me.
Yeah. That's incredible. That's a great compare and contrast there. The visceral productivity that's so tangible that you'd see in an actual working environment, like in Wall Street, versus the sterile academia, the clinical atmosphere of the Fed. It's quite remarkable. Wow, very well said. That is pretty funny. It was the smell. That's awesome. So, how did you tell us about your book, Danielle?
Well, okay. So I said, all right. If we're going to pretend like there's no fire surrounding us and there's no great inferno that's about to engulf the economy, maybe you just need to sit back, calm down, Danielle, and let the world blow up. And then you'll be well positioned. You'll be in the right place at the right time, and then you can move in and make a difference. God bless you. Good luck. Well, that didn't happen either. And that's where the book comes in. So there was a general recognition inside the Fed that the inflation metric that was being used really didn't help policymakers and central bankers see the crisis barreling towards them. So they're like, God, we missed this, and we could probably use a new way of looking at the world. And I'm like, let's do this. Let's come up with a whole new model. This is new Mousetrapville that we're in. Woohoo! Let's go. Revolution, crisis, change. And what they chose to do in the end was keep a broken metric. And that was the point at which I went from saying, you know what, these are well-intentioned, sweet, soft-spoken academics, to perceiving them as people who were willfully blind and exacting harm upon the economy because of their willful blindness. So it went from kind of unintended, if you will, consequences that emanate from misguided Fed policy to, in my mind at least, intended and designed consequences because they knew best. And it was that element and that spirit of hubris, thy name is central banker, that really started to get under my skin in 09 and 10 and 11 and really provided the genesis for the book.
What are some of the things that they were doing that really got under your skin?
Well, it was what they weren't doing, as I just said.
Yeah.
It was, you know, I was seeing in 2012, for example, there was a fairly young Challenger grain Christmas layoff data had been around for some time, and it had been around for long enough to seasonally adjust it. So, woo, yay, wonderful, great. We could present it to President Fisher safely, and he wouldn't go off to the FOMC and be embarrassed because he was citing non-seasonally adjusted data. Well, this is just one example, but Challenger Gray rolled out a hiring series to accompany their layoff announcement series. So it's 2012, and you're starting to see really strong numbers come in. And you're like, okay, the labor market's heating up, and there's really good news building up in the pipeline. And so why were we discussing QE2 and further injections of heroin into the patient? Maybe we should just sit back and let the obvious positive momentum that's building play out. And if the financial markets throw a hissy fit, so be it. We're not supposed to be beholden to the stock market and to Wall Street investors every time they say, wah, wah, give me my binky. But that was what that was one of the things that it irritated Richard Fisher, and he made many speeches about it publicly. Of course, I was by definition silent at that point. But it was very irritating to some of the more hawkish members of the FOMC, Jeremy Stein, Charlie Plosser, Philadelphia Fed, because they were kicking and screaming, saying, "This is too much. We don't need to placate investors. That's not our job." Right. And yet, but it was very satisfying for politicians who operate on an 18-month campaign schedule to make sure the stock market never decreased. Yeah.
Why do you think that this mentality exists? You know, this collusion between Wall Street, the Fed, and then the politicians. That nobody's really looking out for the long-term benefit of the country. It seems like always the proverbial can is being kicked down the road.
You know, it is, and I'm not. I wish I could give you a good explanation as to why outside of the old adage that you just brought up, insanity. You know, the definition of insanity. I don't have a good answer for you. I really don't. Yeah. It started with Greenspan, and somebody actually wrote a very comprehensive biography of Greenspan recently. I believe his last name is Donnelly, and I'm probably misstating his name, but his basic conclusion was that Greenspan didn't want to disappoint his fan base. And you know, I paraphrase here, but it really was this sensation of being popular and not wanting to do unpopular things as a result. And that is not what and or how you would describe an independent, objective central bank. You do things because they're the right thing to do in the long run for the economy, and yet our central bank started behaving more like a publicly traded company and being very reactionary and short-term in its thinking and policy-making and decision-making.
Correct. Absolutely. What do you think are some of the things that needs to change with the Fed, and what the public, what can we do to help, unravel the mess that we're currently in?
Well, I think it's going to be one strong leader at a time. I consider it to be a huge compliment that Zero Hedge went after me. because I was too simplistic in saying we needed fresh leadership at the Fed and that would solve all the problems. And, my response is read the whole book, not just part of it. I think that President Trump will have 6 of the 7 vacancies. We'll have 6 of the 7 positions on the Federal Reserve Board. If you can't change an organization with 6 of 7 people, I mean, God help us. You wouldn't need to audit the Fed if the Fed was independently manned. So that's A. But B, it's an organization that geographically still resembles its 1913 birth. Well, that was when the 12th district of most state of California, Washington State, Oregon, this was considered to be kind of an outback, and there were certainly no economic powerhouses. And yet, I think we could all agree that when Janet Yellen was in charge of the 12th district, she could have used a few extra eyes and ears. So believe it or not, I'm actually suggesting we add to the bureaucracy and put another district out west to better reflect the fact that it's the largest economy in the country. It's the same size as France, economically speaking, Texas being the second largest economy. But by the same token, look, I love the people of Cleveland and Minneapolis and St. Louis, but I don't know that they're necessarily economic powerhouses as they were in 1913 when the Fed was conceived. It's perfectly feasible to me that you could round a few up, handful of them, and absorb them into the Chicago Fed district and not really lose anything in terms of market intelligence and regulation and supervision and eyes and ears on the ground. So I'm being long-winded here. My point is, take the number of districts down from 12 to 10. And then, last I checked, sitting here in the great state of Texas and looking out west at California, our economies are not irrelevant every 3 years. So why on earth should the presidents rotate off of voting every 3 years? And keep the power, that ends up cementing the concentration of power at the New York Fed, which has a permanent vote, and in Washington, D.C. And that's where I think a lot of the problems have stemmed from. So take a step back and say, you know what? The whole country needs to be represented permanently, constantly, and give everybody permanent votes.
Got it.
And as I mentioned earlier, take the mandate down to the single inflation mandate. And again, you do all of these things, and all of a sudden the impetus to audit the Fed goes away, and the impetus to end the Fed goes away. Instead, you have an apolitical, strong, independent institution.
Okay. So to create this apolitical institution, we obviously need to change the current embedded culture in the Fed that this wanting to please Wall Street, wanting to please the politicians. Do you think, what you propose would really achieve that?
Look, I think we've got to give radical reform a chance.
Yeah.
I really do. All of this talk about ending the Fed sounds there's such good sound bites. And, they've become a corrupt institution and all this stuff. And I'm like, well, yeah, they have. And I agree with the criticism wholeheartedly. But you also can't turn a blind eye to the fact that some of the largest financial institutions in the world, are in China today. And there are some very large banks like, Deutsche Bank. There are some very large international footprint banks. And to suggest that we don't need a strong banking regulator and we don't need an entity to safeguard the buying value of the U.S. dollar, I think is far-fetched. It's unreasonable and unrealistic. But you have to start somewhere, and hopefully you bring in people who don't have an agenda and are not married to some economic school of thought. The original 1913 Federal Reserve Act dictated that the U.S. president put people on the Federal Reserve, quote, from a diversity of industries and geographies. Well, last I checked, 12 of the 17 leaders of today's Fed are either PhDs in economics or lawyers. I don't think that defines diversity. But you've got to give radical reform a chance. I'm sorry. I'm just pointing out the obvious here. I'm the queen of the obvious.
Yeah, it's a very good point that you make. I mean, you're right. There is no diversity. It's all banksters and lawyers, basically two classes of elite level liars, okay, and loophole finders. But you're right. If we had a more diverse background where you got people from various different areas of industry like manufacturing, this, that, and the other, we can actually get a more diversified not only culture but actually put out real creative thoughts apart from the typical dogma that's been running for the last 100 years. I mean, my God, that would really not only shake things up, but freshen things up big time. Jeez.
It would, and I'm not trying to say you need to put a bunch of businessmen in there, which, freaks people out.
Sure.
But by that same token, there are a few states and municipalities whose pensions have weathered the onslaught of zero interest rates decently. Call upon those pension fund managers who have managed in a world that's been starved of yield to not necessarily send grandma's money off to the slot machine in Vegas. Bring in people who have been on the receiving end of Fed policy and managed to weather through it, but recognize in their bones, after the next recession, let's make sure we never go back to the zero bound because it creates so many distortions. As opposed to one way of thinking, one trick pony. Oh, dear Lord, we're in recession. Let's slam rates back down to the zero bound, even though we know it doesn't work. Let's blow the balance sheet. Maybe a $4.5 trillion isn't big enough. Maybe a $10 trillion balance sheet would do it, even though Fed research says that QE didn't work.
Yep, that's very well said. Very well said. Danielle, where can people find you? How do you, your website, your social media, where they can get your book? Please feel free to plug that.
I will plug away. I mean, put your seatbelt on, because I've got a big old long name. But DiMartino Booth is my website, DiMartinoBooth.com. Go sign up for my newsletter. Look at my archive. I'm still free. Notice the word still. Follow me on Twitter at DiMartino Booth. I spent the better part of 4 days in Christmas week and New Year's week in the studio recording my book. So the Audible reviews have actually been better than the written reviews if you look on Amazon. So download the book, put it on your Kindle, go to Amazon, walk into your Barnes & Noble, buy Fed Up. And let me tell you, this is probably TMI, but you don't make money on books. The book is not about me, and the book is not about making money or cutting royalty checks or anything of the sort. The woman who recorded my Audible, the woman who recorded my audiobook, the book that she had done prior to my book was like a lifestyle book. She didn't know about the stock market or the economy or any of that. But she was so empowered by the book, and she understood it so well because it's written in layman's terms on purpose. I try and take all the professor out. Even though I've got a great education, I understand economics and finance up and down. It's in layman's terms. Get the book, give it to your mother, give it to your father, give it to your 18-year-old kids, have them read it, because I think that the country can rebuild itself and get away from a debt-driven society if we grasp financial literacy, educating people one person at a time, and the book is a great place to start.
Absolutely. Very well said. Danielle DiMartino Booth, thank you so much for being on, for joining us, for sharing your insights, your experience, and the great work you've done on the book. Guys, go get it. Fed Up. We have copies here at Rogue Money. You guys need to get it yourself and support the work and endeavors of Danielle. And also, those ideas that she put forth are very, very powerful. They're very poignant. And it's something for us not only to think about, but to take action upon. With that being said, thank you all so much for listening in, and have a great day.